50-year mortgage, a game changer, or is it a gimmick? What if I told you there's a mortgage that you could still be paying when you're 110, maybe even 120 years old? Does this sound crazy? Like a late night infomercial for an easy homeownership solution? But these are real proposals. It's a real proposal making waves right now. President Trump's administration is floating a 50-year mortgage to tackle the housing affordability crisis. I'm Darren Hunter, and I've been doing this for 23 years. And I remember when the 40-year mortgage came out, and I'm here to break down the truth behind the headline grabbing change. And they're revolutionary fixes to help you achieve the American dream of homeownership, or is it just risky gimmicks that could cost you significantly? So stick around because the answers, they may surprise you. So why are these changes happening now? Let's set the stage a little bit. Housing affordability in the U.S. is at crisis levels. We've heard about this ad nauseum. Home prices surged over the past few years, surging to all-time highs. Meanwhile, mortgage rates jumped to their highest levels in 15 years, coming off a decade from 2011 to 2022 when rates were ultra low. The result? The income needed to afford a median home has absolutely doubled since 2019. Incomes simply haven't kept up with the cost of buying a house. Many aspiring homeowners, especially first-time homeowners, feel locked out. The American dream of owning a home has never been more difficult to reach. Enter the new proposal and the new solution. President Trump's team, along with FHFA Director Bill Pulte, announced on X that they're working on a 50-year fixed-rate mortgage. The goal? Lower monthly payments to boost affordability for stretch buyers. But will this really move the meter? It's a bold attempt at affordability. I'll give them credit for at least trying to accomplish something. A 50-year mortgage, half a century sounds unprecedented, but essentially it's an extension of the familiar 30-year fixed. Why are we even considering it? It's simply put, extending the term reduces the monthly payment by spreading the loan principal over a longer period in time. In theory, that could help buyers struggling with high prices and rates to qualify for a home or afford their monthly payments. It's the same logic behind the 30-year mortgage when that became more popular than the 15-year. The longer the term makes the payment more manageable, even though you pay more interest over the long run. This idea didn't come out of nowhere. It has been teased by FHFA Director Bill Pulte at a recent housing industry conference and then endorsed by President Trump on social media. They see it as one more tool to boost housing affordability amid sky-high costs. To be clear, the 50-year mortgage isn't available yet. It's a proposal under discussion, and it's not official policy at the moment. And crucial details like who would even offer it, how would it be implemented, and whether it would be federally backed are still unknown. But we do have enough information to analyze how it would work if it becomes reality. So let's break down the math and the trade-offs behind a 50-year mortgage, long-term, higher rates. There's no such thing as a free lunch, as they say. First, a crucial point, longer-term loans come with higher interest rates. Lenders charge more for a 50-year mortgage versus a 30-year mortgage because of the additional risk of lending money over a much longer time. The further out you go, the more uncertainty about inflation, future rates, and the borrower's credit risk. Historically, we see this with a 15-year versus a 30-year. The average rate from a 30-year to a 15 is about 0.5% lower. So you can bet that a 50-year mortgage is going to be even higher than a 30-year mortgage. How much higher? Housing Wire projects about a 42 to 57 basis point increase for a 50-year mortgage compared to a 30-year. For example, if the current 30-year mortgage is 6.22, a 50-year mortgage might land around 6.64 to 6.79 on average. In other words, you start with a higher interest rate just for choosing the longer term. That's the price of the smaller payments. The bank is not doing this out of charity. To put it simply, with a 50-year mortgage, you'd pay a premium in interest rate to buy yourself a lower monthly payment. It's important to remember that as we look at the monthly savings, because those savings don't come for free. Let's quantify both the payment difference and the long-term cost. Will a 50-year mortgage really lower my payment, and by how much? The main and really only selling point, in my opinion, of the 50-year mortgage is a lower monthly payment. By stretching the loan term out another 20 extra years, you spread the principal into many more installments. So yes, the monthly principal and interest, the P&I payment, will drop a bit. But how much difference are we talking about? Surprisingly, not nearly as much as you might expect. Let's use some examples for illustration. Say you need a $400,000 mortgage. We'll use the rates mentioned earlier, 6.22 for a 30-year and 6.64 for a 50-year. That's about a 42 basis point rate premium. Under those assumptions, on a 30-year fix, the monthly P&I payment would be about $2,455. On a 50-year fix, the payment would drop to roughly $2,297. That's about $158 less per month. Roughly 7% reduction in monthly payment. Now, it's not nothing. $158 can make a difference for a tight budget. It could be the difference that helps a home buyer meet the debt-to-income ratio requirement or simply feel less stretched month to month. However, compare this to the jump from a 15 to a 30. Going from a 15 to a 30 typically cuts the payment nearly in half. Going from a 30 to a 50-year shaves off only 7%. As analysts put it, stretching out amortization to 50-year yields higher total interest and less equity buildup, all just for a few $100s in savings. Something that a mere 0.5 or 1% drop in rates could achieve instead. In other words, if market mortgage rates fell from, let's say, 6.5 to 5.5, that would give a similar payment relief without needing 20 extra years of payments. I applaud the attention to help young buyers, but I worry this particular fix is inefficient. Let's keep those monthly savings in perspective. $158 a month could be meaningful for some households, absolutely. It might help at the margins. A few more people qualify for loans or affording groceries along with their mortgage. But will it suddenly make unaffordable homes affordable? If a house is out of reach with a 30-year loan, a 7% lower payment probably isn't a game changer. This is mostly policy theater, and the shifting from a 30-year term to a 50-year term is marginal for most monthly costs and does really nothing to help the lower down payment barriers. In short, it's not addressing the core problem of high prices. It's a Band-Aid at best. What about the enormous long-term cost? Double the interest and slower equity. Where the 50-year mortgage really shows its colors is in the total cost over the life of the loan. With an extra 2 decades of compounding interest and a higher rate to boot, the amount of interest paid becomes staggering. If you cringe at how much interest you pay on a 30-year mortgage, brace yourself for 50-year numbers. Using that same $400,000 loan example, over 30 years at 6.2, you'd pay about $483,000 in interest by the time the loan is fully paid. Now, over 50 years at 6.64, the total interest balloons to roughly $980,000. Yes, you heard that correctly. Nearly $1 million in interest on a $400,000 loan, which is more than double the principal. That's also roughly $500,000 more in interest compared to a 30-year loan. You'd pay almost twice for the house by the end. One $400,000 house and another $980,000 for just the privilege of paying over 50 years. Now, realistically, most people do not keep their mortgages for the full term, especially not for 50 years. I can't even imagine. A common critique of this proposal: who wants to be paying off a house for 50 years? You'd be in your 80s or 90s and it would just pass on to your kids to finish. It's a valid emotional reaction, but remember, very few people stick with their loan, even for 30 years and even for 15, frankly. People move, they sell, or they refinance. The typical U.S. homeowner tenure right now, is really due to the fact that we have that lock-in effect, is about 11.8, and that's climbed significantly over the last couple of years. So in practice, even someone who took out a 50-year mortgage, they might only hold the loan for maybe a decade. But here's the catch. In those early years, a 50-year loan builds equity painfully slowly. Because the term is so long, the amortization is extremely gradual, and in any mortgage, your first year's payment go mostly towards interest rather than principal. With a 50-year, the effect is on steroids. After 10 years, a 30-year borrower would have paid down roughly 20% of their principal. In contrast, a 50-year borrower after 10 years has only paid off about 9% of the balance. Think about that. A decade in and you've barely dented the loan amount at all. You'd still owe around 91% of that balance and then another 40 years to pay interest. This slow equity build means you're leveraged longer and you have less wealth from paying down your loan. There's no amortization gain. It could leave homeowners feeling trapped. If home prices stagnate or fall during the first 5 to 10 years, a 50-year borrower could easily be underwater or have negligible equity, making it hard to refinance or sell without a loss. Even in normal conditions, you'd build usable equity, say 20%, to ditch the mortgage insurance or trade up to a new house, much later than you would with a 30-year. It also means more of your money goes towards interest versus building your own net worth. Will homeowners actually embrace a 50-year loan? Given the downside, higher interest rate, double interest, snail-paced equity, why would anyone take this deal at all? The reality is most borrowers won't stick around for 50 years and many will avoid this loan outright unless it's the only way they can buy a house. This product would be likely very niche, aimed at a marginal buyer who are right on the affordability edge. For example, a first-time buyer in an expensive market who just can't afford a 30-year payment might use a 50-year as a stepping stone to get into homeownership. They might hope to refinance later or ride enough home price appreciation to make it worth their while. If the housing market were expected to boom like 2012 through 2022 when prices skyrocketed, taking a 50-year mortgage loan to get into the market could make sense. You'd gain from the rising home equity even if your loan equity is slow. Better to own something with a 50-year loan than to keep renting and gain nothing is the way the argument would go if home values are climbing fast. However, in a flat, modest appreciation environment, which many forecast for the coming years, and I fully expect to be in that same pool, the 50-year is far less appealing. If home prices aren't rising much, the only equity you would get is what you pay down. And that, as we saw, is very little in the early decades of the 50-year term. In a scenario where the market is normalizing, and indeed we're seeing more supply, slower price growth lately, affordability might gradually improve on its own. Prices leveling, incomes rising, making extreme loan terms unnecessary. There's also a psychological aspect. Public reception to the 50-year mortgage idea has been lukewarm at best. A recent poll done by Resi Club on Twitter or X found a majority of respondents reacted unfavorably or very unfavorably to the concept of a 50-year loan term. Many see it as a gimmick, essentially stretching people even thinner over time rather than addressing why homes are so expensive in the first place. The lack of enthusiasm matters because for a 50-year program to be rolled out widely, it would likely need political and regulatory backing, possibly even changes to mortgage regulation, as a 50-year terms might not meet current qualified mortgage standards in some cases. If politicians sense that the voters hate this idea, they may be reluctant to push it forward. Indeed, given the tepid response, the odds of a true nationwide 50-year mortgage being implemented soon are relatively low. This might end up as more of a trial balloon or a specialized program rather than something every bank offers over the next year. Bottom line on the 50-year mortgage, it's an interesting attempt to ease monthly payments, and it could help some small subset of buyers on the margin. But it's not a silver bullet by no stretch of the imagination. For the affordability crisis, the monthly savings are just modest, and the long-term costs are enormous. As a mortgage professional, I worry about borrowers focusing on, can I afford the payment today, and not realizing how much extra they'll pay over time or how little equity they'll build. If your loan officer suddenly offers you a 50-year term, make sure you understand the trade-offs completely. In many cases, you might be better off exploring other options, like buying a smaller house, improving your credit to get a lower rate, or simply waiting and saving more, rather than signing up to pay a mortgage until the 2070s. Remember, homeownership is a long game. The goal isn't just to buy a home, but to keep it and build wealth from it. Taking on an overly burdensome loan, whether through super extended terms or a super high risk based cost, can undermine your goals. This new option should be considered as a last resort, in my opinion. Special case tools, sure, but not first. My advice to buyers, if you're a prospective home buyer hearing all the news, here's my take. Don't get caught up in the hype. A 50-year mortgage or a reduction in minimum credit score, which is another concept that we'll talk about in a future video. Don't get caught up in the headlines, but always ask, what's the catch? In these cases, the catches are more interest, more years, and more fees. Make sure any loan that you choose fits your budget and your long-term plans. Remember, run the numbers with a professional. If you're curious how a 50-year would compare to a 30-year, ask your lender to show you a side-by-side comparison. See the total interest paid, not just the monthly payment. If you're considering a lower credit conventional, have them compare it against an FHA loan. A good loan officer will transparently show you the difference in rate, mortgage insurance, etc. So you can make an informed choice. That's what it's all about, being educated so you can make an educated decision. Focus on fundamentals. Ultimately, housing affordability won't be solved by fancy loan products alone. We need more starter homes, higher incomes, maybe lower rates, things policy can influence indirectly, and supply as a nation, we need to build more homes. These low tweaks are small pieces of the big puzzle. Make sure you're not stretching beyond your means, hoping a new loan type is the answer. Sometimes the tough truth is that prices are what they are, and you might need to adjust your expectations or your timing. I applaud the efforts to think out the box. Giving consumers more options is generally good. But I also know from over 20 years of doing this that the best outcome for buyers comes from sound financial planning, not over leveraging. If something feels like an affordability hack, be skeptical. There's no free lunch in finance. It always comes back around somehow, and usually it's dollars paid. Thanks for sticking around with me on this super shallow but deep dive into the 50-year mortgage. Make sure you subscribe for any more real mortgage insights. I'm Darren Hunter. We'll see you on the next one. And as always, this was absolutely 100% guaranteed.